Good evening, everyone.
Good evening. We will start the session within 5 minutes.
Okay, sir.
Dakshit sir, can we start?
Yes, sure.
So, uh, good evening
Hello,
all.
sir. Yes. Yeah.
Today we have our fifth session on the uh, income tax series, and the topic is one of the interesting one, and that is capital gain. And capital gain contains two parts: long-term capital gain and short-term capital gain. And with us, our speaker, CMA Dakshish Choksi, who has so far regarding income tax. So he is going to deliberate today on capital gain. So I request him to take over the session for capital gain. Dakshish sir, over to you.
Very good afternoon, friends. Today's topic is capital gain. And let me tell you that the topic is a little complex topic and a little lengthy also. So what I have planned for this session is that we would not go for the basics. We would try to understand the critical issues under the capital gain, and we will focus on certain issues, and then we will go through certain important case laws. So as all the attendees are the members, and as they would be very much aware of the basics things, so I have decided not to go for the basics because the time and the subject and the complexity of the topic would may not make it possible to touch all the basic things. So with this background, I think my screen changing? Hello.
Yes, sir.
What could you see the major amendments? Which slide is there?
Sir, it is not in a presentation mode right now.
So
Please
I'm
put it
trying
in
to change it.
presentation
Let me
mode.
tell you why it is not happening.
Slideshow mode. Sir.
In my screen, it is on the presentation mode.
Sir, please back.
एक second. I think still it is not under presentation mode, right?
Yes, yes, not presentation mode.
I don't know why it is not changing.
There are some options at the bottom of the screen. You
No,
can
no,
go.
I'm touching that. Now you can see I'm trying to slide show. I already pressed that. So in my laptop, it is coming in the presentation mode.
Slideshow. Sir, please go in side slow tab.
Slide slow.
Tab of
Please.
slideshow.
एक second.
તમ લોકો પેલું અંજીર ને એ ખાવ નહીં બ્લુબેરી અંજીર તો ખાઓ ઝરવાન ના તાપ
Just give me a moment, please. Somehow I'm not able to do it. Let's now proceed with this only. Hello.
Yes, sure.
First of all, we will try to understand there are certain major amendments under the head capital gain into the present budget. So first we'll understand what are those important amendments in the recent budget. One such important amendment is conversion of gold into EGR, electronic gold receipts. Then second is limits of deduction under section 54 and 54F. They have prescribed certain upper limit. Then there is a provision for capital gain in case of market linked debentures. Then there is a provision of removal of double deduction on interest borrowed for funds for house property. And then cost of acquisition in case of goodwill, trademark, or brand name, like intangible assets. So we'll study these major amendments one by one. Conversion of gold into EGR. Just give me a moment. See, in the budget 2018-19, the government had announced its intent to establish a system of regulated gold exchanges. And for this purpose, SEBI was notified as a regulator, and SEBI had come out with SEBI regulations 2021 also for operation of gold exchange. So further, SEBI had declared the instrument for trading in gold exchange also, that is EGR, as securities. So the idea was to facilitate the new developments. It was decided to bring in these provisions. So what does this provision say? So this provision says the conversion of physical gold, which is held as capital asset, into EGR issued by. So they are speaking of the physical gold which is held as capital asset. Physical gold which is held as stock in trade is not covered in this. The provision says the period of holding of EGR would include even the period for which the physical gold was held, and vice versa. So in this way, the government is now promoting issuance of EGR. The cost of acquisition of EGR also will be deemed to the cost of the gold in the hand of the person in whose name EGR is issued. Similarly, where gold is released against the EGR, the cost of acquisition of the gold shall be deemed to the cost of the EGR. So whether you are holding gold or whether you are holding EGR as a capital asset, both would be the same. So the question remains whether indexation benefit on transfer of EGRs or physical gold would be available from the date of conversion of EGR into physical gold or vice versa, or from the original date of acquisition of the asset. So I think this will be clarified later on. We don't find any answer to this. Another question would be about the long term and short term. As we know, physical gold, the time period of 36 months is applicable for considering it as a long term capital gain. Whereas for listed securities, the time period of 12 months is considered to qualify for long term capital gain. Now what will happen once EGR are issued? EGRs are considered as securities, and once it is listed on the stock exchange, EGR would also become securities listed on a recognized stock exchange. So the question would remain, like other securities which is listed securities on the stock exchanges, where the time period of 12 months is applicable, whether in this case the period of 12 months would apply or 36 months would apply. So I think that we'll find the answer to this at a later stage. Government must come out with the clarification on these issues. Presently, I'm not able to find out an answer to this. Another important amendment is about deductions under section 54 and section 54F. At present, there was no limit, there was no restriction, but now the benefit is restricted to 10 crores. So as we know, section 54 is applicable for a residential house and section 54F is applicable for any long-term capital assets other than a residential house. And if a house is purchased within 1 year before or 2 years after, or construction is made within a period of 3 years, then deduction is available to the extent of cost of new residential house. Now, by this amendment, the government is restricting the benefit to rupees 10 crores only. So now the question would come how the calculations of rupees 10 crores would be made. In the next slide, we'll study how the calculations under section 54F will be made. So if say sale value of the old capital asset is say 30 crores, capital gain earned is 15 crores and investment in the new house is made of 30 crores. So now instead of 30 crores, the government said that the benefit would be restricted only to 10 crores. So it's not that once he has invested entire 10 crores, entire 10 crores would become eligible. No, the explanation says that the deduction under section 54F would be restricted to the ratio of rupees 10 crore to the sales value of the asset sold. So even if the person is investing 30 crores, he would not be able to get the benefit of entire 10 crore because the restriction, the deduction would be restricted in the ratio of 10 crores to the sale value of the asset sold. So in this case, the deduction under section 54 would become 5 crores. It would be like if we consider D is the 10 crores, then D divided by A. A is sale value of the old capital asset. So 10 divided by 30 into capital gain earned. So which would become 5 crore. So this is how, this is already explained in the explanatory note by the government that the calculation of rupees 10 crores would be restricted in this fashion. Another concept is come of market link debenture. Now what is market link debenture? The expression market link debenture is defined in explanation to section 50A to mean which a security which has an underlying principal component in the form of a debt security and where the returns are linked to the market returns on other underlying securities or indices and includes any security classified or regulated as a market link debentures by the SEBI. So presently, these securities are taxed as long-term capital gain if it is held for a period of 12 months. The finance bill proposes to insert a new section 50A and it is proposed that income from such instruments would be taxed as short-term capital gain irrespective of their period of holding. So even if it is held for a period of more than 12 months, it would be considered as short. Now, another important change is about the reduction on interest on borrowed funds for a house property. So presently we know that interest on capital borrowed for purchase of house property is allowed at a reduction under section 24B under the head income from house property. This we had seen when we had studied the chapter, the session on the income from house property. Further, such interest can also be regarded as cost of asset of immovable property under section 48(2) of Income Tax Act. So while we calculate capital gain, the interest paid on capital borrowed for purchase of house property can also be added in the cost of acquisition. So what was happening? Interest which we paid on the borrowing was, we were able to claim reduction under section 24B also, under the head income from house property. And under the same thing, while we were calculating the capital gain, the cost of acquisition also, while considering calculating cost of acquisition, we were adding the interest portion also. So the proposed amendment says that cost of acquisition will not include the amount of interest which has already been claimed as reduction under section 24 or under chapter 6. So previously, the SSE was able to claim double benefit of interest on capital borrowed, one in the form of reduction under the head income from house property, and other in the cost of acquisition of the asset. So now this analogy is removed, and if interest is claimed either under section 24 or under chapter 6A, then it will not form part of the cost of acquisition. Another amendment is about the cost of acquisition of goodwill, trademark, or brand name. This amendment says that if it is a self-generated goodwill, like goodwill for which no purchase price has been paid, so the cost of acquisition for all such type of intangible assets would be considered as nil. Now this amendment is to nullify the effect of few judgments. Like in a few judgment, it was held that transferable development rights are not covered under section 55 because their cost is not determinable. So hence, the capital gains cannot be computed because any asset for which cost is not determinable, capital gain cannot be computed. And so it was not subject to, it was not accepting the definition of the transfer. So this proposed amendment says the cost of all such intangible assets for which there is no acquisition cost would be considered as the nil. So with this background of the proposed amendments under the latest budget, let's try to understand the critical issues under the capital gain. So for any asset for capital gain, there are certain fundamental things which is required. One is that must be capital asset. Another thing is there should be transfer of such capital asset. There must be consideration for such transfer. The acquisition cost of such capital should be quantifiable, and there must be profit or gains as a result of the transfer. So if these 5 basic things are satisfied, then it will fall under the head capital gain. So now, without going into the basics of the capital gain, let's try to understand the complex issues under section 45(4) and under section 9(b), which is income on receipt of capital asset or stock in trade by partner from the firm. So whenever I say partner or a firm, it would include, whenever I say firm, it would include AOP and BOI also. Whenever I say partner, it would include the member of AOP or BOI also. So these provisions is applicable, equally applicable to partnership firm, AOP, and body of individuals. So first, let's understand section 9(b). Section 9(b) speaks of receipt by a partner from the firm. Now, this can be in the form of either capital asset or stock in trade or both. So first thing we should understand what is included under section 9B. Section 9B says any receipt of a capital asset or stock in trade or both by a partner from the firm would fall under this section. So that means that if it is a money, if it is a cash given by a partner from the received by a partner from the firm, then this section would not be applicable. So to repeat, this section would be applicable only if there is a transfer of a capital asset or stock in trade or both by a firm to the partner. If it is in the form of cash or in the form of money, then this section is not applicable. This is applicable in both the form, either in the case of dissolution or in the case of reconstitution. We'll see at a later stage what is meant by reconstitution. So who is liable to pay tax under section 9B? Though the receipt is by a partner, the tax liability is by the firm. The firm is liable to pay tax. So in what form?
Profit again.
It will be under section 28 as business income if it is stock in trade, and or if it is a capital asset, it would be under section 45(1) as capital gain. So depending upon the transfer of the asset, the tax liability would arise. If it is stock in trade, then naturally section 28 would be applicable. It would be fall under the income from business income. It would be tax as profit of gain from business or profession. And if it is a capital asset, section 45(1) would get attracted and it would be taxable under the head capital gain. How the capital gain would be calculated? Considering the fair market value on the date of such transfer. So let's understand this section is applicable in two cases, both the cases, dissolution or reconstitution. So what is meant by reconstitution? Reconstitution is when one or more partners ceases to be partner. So there has to be minimum 2 partners should continue. Suppose there are 3 partners and one partner gets retired or changed or he ceases to be a partner, then it is a case of reconstitution. So suppose if there are 2 partners only and one partner ceases to be a partner, would it be deemed to be reconstitution? No, because when there is only one partner, it is not a partnership firm. It turns out to be a proprietorship firm. So there has to be minimum 2 partners should continue for a reconstitution. Sometimes what happens that in the partnership deed, when there are 2 partners, sometimes a general clause is kept that if any partner dies, then his legal heir would become the partner. So under such circumstances also, I would say that this is not a valid thing, because when one partner dies, there remains only one partner. So another partner can be admitted only after the death of the partner. And when the death has occurred, there are no 2 partners. There is only one partner. So this clause has got relevance. It cannot be said that now the firm would be reconstituted with the legal heirs of the second partner. So reconstitution is one or more partner ceases to be partner, admission of a new partner. So here also it's not that all partners retire and all new partners should come. At least one old partner should continue. And next is no partner retires, no partner ceases to be a partner. There is no admission of a new partner. There is only change or modification in the shares of the partners. So these also falls under the reconstitutions. many times in our partnership firm of our professional firm, we change the share of the partners internally. So this falls under the reconstitution. So let's understand the tax implication under section 9B by way of an illustration. Is my next slide is on the screen, illustration, showing the illustration? I think it's taking time to change. Yeah. So as we state that this section is applicable in the case of either dissolution or reconstitution of the partner. Now study this case. There are 4 partners. All the four partners have the equal share, 25% each. And partner A resigns on 31st of January. Now balance lying to the capital account of Mr. A is 40 lakhs. So how the account is settled? There is a cash payment of 5 lakhs which is made. Then there is a stock in trade whose purchase cost was 3 lakhs rupees and its fair market value is 5 lakhs rupees. Then there is a land whose index cost was 20 lakhs. Purchase cost may be 15 lakhs. For simplicity, I have considered index cost also here because while calculating the capital gain, we need to add the index cost. We need to consider index cost. So index cost is 20 lakhs. Fair market value is 30 lakhs. So the provision of 9B says whenever you give anything to the partner, you have to treat that as if you are selling these things to an outsider, and accordingly the tax liability would arise. So here in this case, the cash payment of 5 lakhs is outside the jurisdiction of section 9B. As said earlier, even if it's a cash payment, this section needs to be ignored. This section is applicable only in the case of stock in trade and land and these capital assets. So stock in trade, simple things. FMV is 5 lakhs, purchase cost 3 lakhs. So 2 lakhs would be considered as profit from business. As far as the land is concerned, the index cost is 20 lakhs, fair market value is 30 lakhs. So capital gain of 10 lakhs would be charged. So the taxability under section 9B is very important because it considers the fair market value on the date of transfer, and on such a value, the firm is liable to pay the tax as if such thing has been given to an outsider, it has been sold to an outsider. Now linked to this, there is another important section, which is section 45(4). Section 45(4) also speaks about receipt by a partner from the firm. Here, section 45(4) is applicable only in the case of reconstitution. Section 9B is applicable in both the cases, whether dissolution or reconstitution, whereas section 45(4) is applicable only in the case of reconstitution. Section 45(4) considers capital asset or money or both. So here, stock in trade, current assets are not considered. Section 45 falls under the head income from capital gain. So here, only capital assets are considered. So now see the difference between section 9B and section 45(4). Section 9B, both this dissolution and reconstitution. Section 9B considers both stock in trade and capital assets, whereas section 45(4) does not consider stock in trade. Instead, section 45(4) considers cash receipts, whereas section 9B ignores cash receipts. Same way here also, the liability is on the head of the firm. Now, unlike section 9B, where both section 28 and section 45(1) is applicable, here section 28 is not applicable. Here only capital gain is applicable, because here the section speaks only about the capital receipts. Here also, for considering the capital gain, just like section 9B, fair market value will be considered. So far, so good. This may appear little simpler, that section 45(4) speaks of reconstitution, 9B speaks of both reconstitution and dissolution both. Here only capital assets are considered. In section 9B, capital assets and current assets both are considered, and in the both the case, firm is liable to pay tax. And just under the normal heads of business, if it is stock in trade, it is business income, it is capital asset, is capital gain. But let us understand the complexity of the issues. Let us understand this complexity of the issues by way of an example. So first, we'll need section 45(4), how the computation of capital gain is made. In the act itself, the formula is given, which reads that A is equal to B plus C minus D. A is capital gain. So capital gain is equal to B means money received, C is fair market value of capital asset received, and minus D, that is balance of partner's capital account. So whatever is given to the partner in excess of balance lying to his capital account would be subject to the capital gain. Suppose, to make this very simple, let's see that a partner retires. Balance to his capital account is say rupees 80 lakhs. And the partner is given capital asset whose fair market value is 100. He is also given cash of 10. So total is given 110. So out of 110, what is balance lying to his capital account? It is 80. So balance is 30 is the capital gain. Suppose partner is given lesser amount. If A is negative, then A would be considered as a 0. The effect of revaluation of assets or fair generated goodwill is also not to be considered for capital account balance. Now, the capital account balance is very important. Why? When a partner ceases to be a partner, when a partner retires, why he would be given more amount than what is lying in his capital account? Why a partner would demand more amount? He should be satisfied with whatever balance is lying to his capital account and he should walk out. No, but in the reality scenario, this will not happen. Why? Because the firm would have certain assets whose fair market value would be much more than its book value. Say there is a land which was purchased 10 years back. The book value of the land is 1 crore. But today we see the land price has increased manifold. And after 10 years, the land might be fetching 3 crores of rupees. The firm would have certain current assets, certain stock in trade. So which was purchased at say 10 lakhs rupees, present value is 12 lakh rupees. Not only the increase in the assets value, over a period of time, the firm might be in a position to build up its own brand. The firm might have firm might have created its own goodwill. So definitely the retiring partner would say, give me my share of goodwill, give me my share of the brand, give me my share of increased value of the assets, give me my share of fair market value, which is much more than the book value. So under these circumstances, definitely the outflow to the partner would be more than what is the balance lying in his capital account. So calculation of partner's capital account would be also an important parameter, because this is what would subject to the capital gain liability. Suppose a partner retires on 30th September. Say as on 31st March, the balance lying to his credit is 10 crores. So whether the balance lying now is retiring on 30th September, so 6 months has already passed out. The firm would have earned profit in this 6-month period. Suppose there are 4 partners having equal share and the firm has earned profit of 4 crores. So naturally he will have a share of 1 crore. So he would demand that share of profit for the period for which he was there. So this also needs to be added to his capital account, and this will help us to reduce the balance of capital gain also. How this is done in a detailed illustration, but what I want to point out is we need to plan in such a way that we can reduce the capital gain liability. So before, what are the major points? If A is negative, then it is required to be treated as 0. The effect of revaluation of assets or sale goodwill will not be considered for capital account balance. So if capital account balance on the asset side, if there is a revaluation of assets, then it needs to be ignored and needs to be deducted. In the case of reconstitution, both the provisions of section 45(4) and 9B will be applicable. So does it mean that in case of reconstitution, we may prima facie feel that as in case of reconstitution, as both the provisions are applicable, one is liable to tax under section 9B also. So whether there is a double taxation? No, we'll understand it at a later stage. The capital gain under section 45(4) will be attributable to the remaining capital assets as per rule 8B. Now you are paying capital gain. So why? If there is no hidden revaluation of the assets, then you have paid just the basic amount which is lying in the partner's capital account. You would not have paid more than what is lying to his capital account. So as there is an appreciation and then capital gain is paid, it is attributed to the remaining capital assets. We'll still see this, how this attribution is done in the detailed illustration. And section 45(4), the capital would be short-term capital gain if capital asset is forming part of block of assets like depreciable asset, as we know. All depreciable assets, when it's sold, which is forming part of the block of assets, the capital gain is always short term. In case of self-generated goodwill, it will be always considered short term capital gain. We cannot claim that self-generated goodwill was created before 10 years and so it is a long term. No. And any short term capital assets, if at the time of taxation, the asset is a short term capital asset, naturally it is short term capital gain. So besides all these cases, it will be long term capital gain. Now let us see this with an illustration. There are 4 partners. The capital account balance of all the 4 partners is say 100 lakhs, totaling to 400 lakhs. The company has got 4 fixed assets, line A, line B, line C, line D, having the different value, stock of 75, debtors of 25. Let's ignore this. We'll see this later at a later stage. There is a detailed illustration later. So first we'll understand the rule of attribution. As I said about the attribution, how the rule of attribution works. So the rule of attribution says that if capital gain relates to only capital asset which is received by the partner, then there will not be any attribution. And if capital gain relates to revaluation of any other assets, then it will be calculated like increase in the value of such capital asset due to revaluation divided by total increase in the value of all capital assets multiplied by the capital gain. So we are going to study this in a detailed illustration. But the thing which you need to understand is if capital gains relates to only capital assets which is received by the partner, no other assets are revalued, then there will not be any attribution. And if other assets are also revalued, then the attribution, the capital gain would be attributed in the ratio of increase in the value of assets of over total increase. So let's see a detailed illustration of 9B and 45.4. So DEF and company is a partnership firm. There are 3 partners, D, E, and F. All the 3 are having share of 33%, equal share. And DEF is dissolved on 31st of January. So here, which section would get applicable? As we said that in the case of dissolution, section 45.4 is not applicable. Section 45.4 is applicable only in the case of reconstitution. So here, the tax liability would arise only in the form of section 9B. How we will see this now? Now, as is the case of dissolution, that would be a distribution of the assets. Now, let's understand that there are 3 assets, line D, line E, and line F. The date of purchase is 2010 to 2015. Then we have got a book value, which is 2015 and 17. And then we have got a revaluation. Line D of 20 lakhs was revalued at 60 lakhs. Line D 15 was revalued at 64 lakhs. And line F 17 was revalued at 68 lakhs. Now let's assume that partner D is given line D and cash balance of 8 lakhs plus cash balance of 8 lakhs. partner E is given land E plus balance of 4 lakhs and partner F is given land F. So now let's understand how the capital gain liability would arise. Land D, E and F. So as we see, we have to consider the fair market value on the date of transfer. So fair market value of line D, E and F is respectively 60 lakhs, 64 lakhs and 68 lakhs. Then we have to consider the index cost. Like these assets were purchased in the year 2012, 2015 and 2010. So the respective book value, purchase value cost would be subject to the index cost. So I have mentioned the index here, index of the respective year, and then we have arrived at the index cost. So difference between fair market value and index cost is the capital gain. So here, whatever cash is paid will not be covered here because under section 9B, only assets is covered, only either capital asset or stock in trade. So this is how the capital gain would be arrived at. Now let's see this illustration further. Now there are 4 partners, A, B, C and D, and here the partner D resigns. The capital account balance is also equal. Now this case would fall under the reconstitution. As it is a case of reconstitution, both the sections, section 9B and section 45(4), both would get applicable. So it's a very complex issue. So we'll need to try to understand how the tax liability under section 9B and section 45(4) would get calculated. So here there are 4 partners, all the 4 partners having equal share, and all the 4 partners have got the balance of 50 lakhs each in their capital account. Now let's understand the firm has got 3 assets. Land A, which has got a book value of 25, line B, which has got a book value of 35, line C, which has got a book value of 90 lakhs. Now, as we have to consider the fair market value, all these land would be revalued, and we have got a revalued figure at 40, 55, 190. Now, as I said earlier, the partner would also demand the goodwill. The business is running since last 10, 15 years, and there is a self-generated goodwill. So valuation of the self-generated goodwill was also carried out, and it came out to be 50 lakhs. So now we have got 4 market value of say 40 lakhs, 55 lakhs, 190 lakhs and 50 lakhs. And to settle the account of D is given, now the balance lying to the is capital account is 50 lakhs. But it has been given line B, which is valued at 55 lakhs and is also given cash of 25 lakhs. So to summarize, before we move further, there are 4 partners. 1 partner is resigning. The balance lying to his capital account is 50 lakhs and he is being given land of 55 lakhs, cash of 25 lakhs. So here now we have to calculate the tax liability under section 9B and section 45(4) both. So how this will be done? So first we'll see the tax liability under section 9B. So here the partner is given 2 things, land and cash. So under section 9B, cash is not included. So while calculating tax liability under section 9B, we have to consider only the land. So land, the fair market value is 55 lakhs. Cost of land and index cost is 45. So capital gain 9.39. So assuming that there is a 20% tax, capital gain tax, we are ignoring the cess for the simplicity. The tax liability comes 1.88 lakhs. This appears to be simple, but it will become complicated once we calculate the tax liability under section 45(4) and once we attribute the capital gain tax. So far so good.
Yes,
So
sir.
now let's understand how the profit will be booked in the books of account. Now value of land which is given to partner D is 55 lakhs. Now its book value was 35. So profit in the books of account would be 20 lakhs. Out of this profit, the capital gain, which was 1.88 lakhs, would be deducted. So net profit would become 18.12, which would be divided in 4 partners account. So each partner will get share of 4.53. So capital accounts of partner D, which was 50 lakhs, now would increase to 54.53. So now how the tax calculation under section 45(4) would be done? So while calculating the tax, what is to be considered is cash and fair market value of land both. So here the partner is given cash of 25, fair market value land of 55. So total 80 lakhs is being given. Less is revised capital balance 54 lakhs. So 25.47 would become the capital gain. Now land B is given. Now what is left is land A and land C. Now this, there is already a revaluation of the remaining assets. So the capital gain would be attributed among the remaining assets. So how it will be attributed? In the ratio of revaluation. So let's understand land A, which was having 25 lakhs original cost, increased to 40. So increase of 15 lakhs. Similarly, land C, and there is the goodwill, self-generated goodwill. So attribution of capital gain would be done like now. This 165 would be allocated in the ratio of this increase of 1550. So long-term capital gain of 23.70 would be allocated in land A, land C, and goodwill at 2.15, 14.36, and 7.80. So to make it very simple, we had got capital gain 23.70, which needs to be attributed to the remaining assets. Now other assets are also revalued. So what is the revaluation figure? What is the increase due to the revaluation? In the ratio of increase, the capital gain would be allocated. And then it will be decided whether it is long-term capital gain or short-term capital gain. Now land A and land C, we understand that it is being held for since last more than 5 years. So it falls under the long-term. Goodwill is a self-generated. So it is always called short-term. So capital gain of land A and land C would become the long-term capital gain. The capital gain of goodwill would become the short-term capital gain. And when? Now what will happen to this? Now you have already paid the tax. So when the land A and land D or goodwill will be sold at a future date, this amount, which is the amount of capital gain, which is attributed related to those respective assets would be reduced from the sale consideration. So you will get the benefit of this when at a future date, when you sell these assets, after of the realization amount, the capital gain which is already paid would get reduced, and on the balance amount, the capital gain would get applicable. So this is how section 9B and section 45(4) works. So as it was very complicated calculation of section 9B and section 45(4), I thought let me try to attempt it at a first stage and then we go into detail. So I hope this is clear. Section 9B is applicable in both the cases, whether it is dissolution or reconstitution. Under section 9B, only capital assets and inventory are considered. The cash payment is not considered. Whereas section 45A, only capital assets and money is considered. And section 45A is not applicable in the case of dissolution. It is applicable only in the case of reconstitution. So now let's see what is transfer. We'll just go in a little hurry because this is the basic things. So transfer includes, we know that sale, exchange, relinquishment, extinguishment, compulsory acquisition, and conversion of capital asset into stock in trade. So what is not transfer? Any asset, any distribution of assets when the company is in the liquidation is not considered as transfer. When HUF is partitioned, either total or partial partition of HUF is also not transfer. Any transfer by of will, gift, or revocable trust is also not a transfer. Any transfer by a company to its wholly owned subsidiary or transfer by a wholly owned subsidiary to its holding company is also not transfer. So under this case, the liability of capital gain would not arise. So we have studied section 45(4), which speaks of, and section 9B, which speaks of reconstitution and dissolution. Now let's understand section 45(2), conversion of capital assets into stock in trade. Sometimes we see that, suppose let's take a case of a builder. That is a capital asset and which is converted into stock in trade. So any such conversion of capital asset into stock in trade is considered as a transfer. But the question would be, it is a sale of a capital asset indirectly, it is subject to the capital gain. But when the capital gain would arise, suppose someone converts his capital asset into stock in trade, say on 1st of January. So whether at the time of conversion, the capital gain would arise? No. Capital gain will arise only when such converted asset is sold or transferred. Suppose you have got, say, 5,000 sets as a capital asset. Now you convert these 5,000 sets into stock in trade. And suppose after some time, out of these 5,000 sets, you sold it off, say, 1,000 sets. So when you sell 1,000 sets, the capital gain would arise only on 1,000 sets. When the balance would be sold, at that time only you would be liable to pay the capital gain. So when you sell, two types of taxes would get applicable. One, as when you are selling it, it is your stock in trade. So as a stock in trade, it becomes your business income. So sales value less fair market value on the date of the conversion would be your business income. And capital gain would be calculated on fair market value on the date of conversion less index cost of the acquisition. Now suppose you have converted certain capital assets into stock in trade in say financial year 2021 and you are selling it into year 22-23. So whether indexation of which year would be applicable? Indexation of the year on which you are finally selling it off, or indexation cost when you converted your capital asset to stock in trade. So naturally indexation cost at the time of conversion would get applicable. So it's like this, that when you convert your capital asset into stock in trade, the tax liability on the date of conversion has already arisen, but it is not payable. It will become payable only when such asset is ultimately sold off. So when you sold off, there are two things. One is the capital gain, which was already become due, and the present gain. Both would become payable on the date of actual sale. Now let's see section 28 say conversion reverse of this. Like here we say conversion of capital asset into stock in trade, which is falling under the head capital gain. Reverse to that, conversion of stock in trade into capital asset. This is a part of section 28, which is profit from business and profession. So when you convert your stock in trade into capital asset, it is treated as income from business or profession. So unlike previous case where when you convert, the tax liability, the tax payment was arisen when you ultimately sell it. Here, you are not selling it. You are just holding the asset. Previously, you were holding the asset as stock in trade. Now still you are holding the asset, but now you are holding the asset as your capital asset. In spite of that, the tax liability is payable on the date of conversion. Say in the current financial year 22-23, suppose you are a builder and you have got a building. You decide that now out of the 10-story building, you will use say the first floor for your office purpose. You not sell it. So that becomes your capital asset. So though you have not sold it off that as your stock in trade, now you are holding the same thing as your capital asset. In spite of that, the tax liability would arise on the date of the conversion. So fair market value. So how the tax liability would be calculated? As there is no bank transaction or cash transaction is taking place, how the value would get calculated? So the value would be the fair market value. Fair market value of the asset on the date of conversion less cost of the asset will be your business income. So now onwards, what will happen? That capital asset has become your start claiming depreciation as if it is your capital asset. But the point is whether you claim depreciation or no depreciation, at the time of conversion itself, your tax liability as income from business or profession would get arisen. So there is a difference between conversion of capital asset to stock in trade and conversion of stock in trade to capital asset. In the first scenario, the tax liability arises only when you ultimately sell it off. Here, whether you sell it off or not sell it off, the tax liability arises once you immediately convert it. Now, section 45(3) is very important. It was a very simple case when section 56(2)(10) was not there. That is income from other sources. You might have studied this when the section from income from other sources was there, I'm not sure, but we'll see this as it is linked to section 45(3) indirectly. So section 45(3), what is it about? Transfer of capital assets by a partner to the firm. So whenever a firm transfers any capital asset, it is taxable under section 45(3). So whenever a partner has got certain assets and the partner transfer that asset to the firm, so the tax liability would arise in the hands of the partner. Now, how the amount will be calculated? The provision says the amount recorded in the books of account will be considered as a consideration value. So that is very simple. Suppose I have got an asset. The value of the asset, say I have got a building. The value of the building is say 5 crores. And I transfer it to my firm. And I record in my firm's books of account as 1 crore. Now I have got a building whose book value in my books of account is 5 crores. Say is Jantri value is 7 crores. And I transfer it to the firm, and in the books of accounts, I record it at 1 crore. So what will be the scenario? Section says the amount recorded in the books of accounts will be considered as a consideration value. So to make it very simple, and as per the wording of section 45(3), whatever is the amount recorded in the books of account is considered the consideration value. So 1 crore would become the consideration value. So while calculating tax liability into my hands, 1 crore would be considered as a consideration value. So capital gain liability would not arise. But after introduction of section 56, subsection 2, clause 10, this has become not that simple. Now let's read what section 56(2)(10) says. Section 56(2)(10) is very important section. So now I have opened the Income Tax Act and I would like to read it out. Where any person receives in any previous year from any person or persons on or after 1st April 2017, any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum. B, any immovable property without consideration, the stamp duty value of which exceeds 50,000 rupees, the stamp duty value of such property. And B, for a consideration, the stamp duty value of such property as exceeds such consideration if the amount of such excess is more than the amount of 50,000 rupees or and amount equal to 10% of the consideration. So in such case, the tax liability would get arisen. So here what is happening? Say the fair market value of the property which I am transferring to the firm is 10 crores. I am transferring it to at rupees 1 crore. So there is an inadequate consideration. The firm has received inadequate consideration. The fair market value is 10 crores. Firm has received 1 crore. So the section 56 subsection 2 clause 10 would get triggered. And the firm would be liable to pay the tax. So earlier, before 2017, the flexibility which one was having, it transfer capital asset to the firm at any value, and that value which is recorded in the books of accounts would be considered as a consideration value, would now get diluted with the provisions of section 56 to 10. Will not have that flexibility which was having earlier. So 56 10 to 10 is very important for all the transfers which is happening due to inadequate consideration. Now let's see slump sale. What is slump sale? Slump sale is sale of one or more undertaking for a lump sum amount. So what is lump sum amount? When the value is not assigned to individual assets or liabilities and only one figure is given, lump sum, which is called slump sale. So how the tax liability would be calculated? So fair market value of the capital assets on the date of transfer shall be deemed to the full value of the consideration received as a result of transfer. Now the question would come whether it would be a short-term capital gain or long-term capital gain. So if it is proved that the entire undertaking was held for a period of less than 36 months, then it would become short-term capital gain. If it is held that it was otherwise, it will become long-term capital gain. Here, what will be the cost of acquisition? Like as it is a lump sum consideration, the cost of the individual assets and liabilities is not ascertainable. So net worth of that particular undertaking will be considered as the cost of acquisition. Now net worth may include revaluation reserves, revalued assets. So the effect of revaluation is to be ignored and net worth is to be considered as if the assets were not revalued. We have to delete the effect of revaluation, and whatever is the net worth, that will be considered as the cost of acquisition. And here, the benefit of in slump sale, benefit of indexation is not available. That would be number of assets. Those assets would be purchased over a number of period. So, and as it is being sold as one undertaking without assigning the value to individual assets and liabilities, the benefit of indexation is not available. Now let's see deductions and exemptions from capital gain. The fonts are little smaller. So here I have tried to capture only important sections like section 54. Section 54 is for exemption in the case of house property. It's available to individual or HUF. It's available only if the capital gain is long-term capital gain. The capital gain should arise on, that should be a sale of residential house. So the capital gain should arise from sale of the residential house. And the SSE should purchase within 1 year before or 2 years after the date of transfer, or should construct within 3 years after the date of transfer another residential house. And investment in new assets or capital gain, whichever is lower, would be the exemption amount. Then we have got section 54 EC, which is like section 54 is for especially for residential house. Section 54 EC is for any long-term capital asset being land and building. So here also it should be long-term capital gain to qualify for these reductions. The SSE can acquire bonds of NHAI or REC, etc. And within 6 months from the date of transfer, he has to invest. And the investment, and here the exemption is available up to maximum of 50 lakhs. So investment in new assets or capital gain subject to maximum rupees 50 lakhs, the deduction would be available. And then we have got section 54E, which is any taxpayer can claim the benefit of this. It's applicable for any long-term asset. Units, how what the SSE has to do to claim the exemption. So he has to purchase unit of funds as notified by the government to finance startups. And within 6 months, he has to invest. And here also, the investment is limited to 50 lakhs. And then we have got section 54F. So any long-term capital, any long-term asset other than a residential house property. So if an SSE sells any long-term capital, any long-term asset other than house property, provided on the date of transfer, he does not own more than one residential house property. So this exemption is available to any individual HUF if he sells any long-term asset, provided on the date of such transfer, he should not own more than one residential house property. Then if he purchases another residential house property, then this exemption is available, provided he purchases the another residential house property within 1 year before or within 2 years after the date of transfer, construction, or within 3 years after the date of transfer. So if he purchases within 1 year before or 2 years after, or constructs within 3 years after the transfer, then this exemption is available subject to investment in new assets. And here the net consideration, the entire net consideration needs to be invested. So with this background, I would like to now uh, study discuss important judgments, important case laws. Give me a moment. Give me a moment. We'll just study the important judgments. So let's now try to understand certain important judgments. First is about section 45(1). Here, if there is an unregistered agreement, so what will be the effect? So here what was happened that a joint development agreement was executed with developers for development of a land. And as per the joint development agreement, the SSC received certain consideration, a part of it, and balance concession was to be received later on subject to certain conditions, like the permission from the development authorities. So what happened that though the joint development agreement was already made, which was not registered, and the SSC received part consideration, and ultimately what happened that JDA could not be implemented because the required permission from the local development authorities was not granted. So here the issue was whether the money which has been received, because the possession was handed over in part performance of the JDA, so whether it would be subject to the capital gain or not. So here it was held that the unregistered agreement will not have any effect in law, and it's not binding force in the eyes of law, So no transfer can be said to have taken place. So once it is concluded that there is no transfer, see, to qualify as a capital gain, the important criteria is the transaction should fall under the definition of transfer. So here it was held that as JDA was not registered, and as not registered is not binding force in the eye of law, so transfer would not be regarded as a capital gain. Here the case is about the what can be included under the head cost of improvement. Like we know that cost of acquisition and cost of improvement. When we calculate the capital gain on sale, we need to consider cost of acquisition plus cost of improvement. So cost of acquisition and cost of improvement both are considered as our cost for calculation of the capital gain. So here the point is, what factors can be considered as the cost of improvement? So here what had happened that SSE had entered into an agreement to sell its property, and he received an advance, but somehow after receipt of the advance, the transaction failed. So the SSE sold that property to another one. But he had already entered into an agreement with the old party. So to have clear title, it was required to get the concurrence of Mr. A. So what SSE did, SSE paid certain amount to Mr. A so that he could get the clearance. Because earlier there was already an agreement which was executed by SSE with Mr. A. So whatever amount was paid by Mr. A, by the SSE to Mr. A to get such clearance, he claimed as liquidated damages as a cost of improvement. So the question was whether such payment can be considered as cost of improvement, because in normal parlance, what we see, cost of improvement means what we see that whatever the expenditure has been incurred in the property, like for the development of the property or for renovation of the property, etc., is considered cost of improvement. So here it is a unique case where the SSE has to pay certain liquidated damages to get the clearance of the property. So whether such amount can be considered as cost of improvement or not. So here it was held that such case, the whatever amount has been paid is to get the clear title, like free from encumbrances and for peaceful possession. So it was held that there was a clear nexus between the payment which was made, because without this payment to Mr. A, the free encumbrance would not have been received. And so it was held that there is a link between the expenditure which was incurred for the transfer of the asset. And so as it is a connected transfer, the expenditure was allowed to be included in the cost of acquisition. So it was held that liquidated damages were incurred wholly and exclusively in connection with the transfer of the underlying asset, and hence the same are allowable as reduction under section 48(1). So here the court had also observed, the court had put an important observations that this should not become the criteria for all the cases. The court noted that the above ratio should not be interpreted to mean that whenever an SSE pays amount under an earlier agreement in terms of settlement or even a court decree, the same would be treated as expenditure wholly and exclusively in connection with the transfer. So nature and character of the earlier agreement, its timing, payment, which is being claimed as expenditure, and date of transfer resulting into capital gain. And all these aspects need to be taken into consideration. So this is very important observations by the court, that while deciding the cost of improvement, what could be included, what could be not included, it's not a simple vanilla case. The present circumstances and all other facts of the matter needs to be taken into consideration. Now here, the case is, if an SSC has got a large piece of land, and suppose he has got a very large piece and he breaks it into say 100 parts and then he sells it. So whether such asset would be considered as business income or would be subject to capital gain. One may argue that as he is not selling the entire land in one go, but he is broken it into various pieces and then it is being sold individually, it may have the nature of business income. So here the issue was, the SSC had a large piece of land. He was not in a position to sell the entire land of piece at one go. He was not able to find out the buyer for such a large piece. So what he did, he broke the his large piece of land into various plots, small plots, and then he sold off such plots. So whether the question was whether selling of such multiple plots would constitute as his business income or it would be capital gain. So here it was held that it would become capital gain and not a business income, because this was not a routine business of the SSC. This was like one-off transaction by the SSC. As it was a large piece of land having a large value, it was naturally not possible for the SSC to find out a single buyer who would buy such a large piece of land. So to get rid of such a large piece of land and to realize the amount, it was obvious for him to break the land into different plots and then to sell the different each plots. So it was held that this would be treated as capital gain only and not block of asset or not business income. The assessing officer had treated this as a business income, but the tribunal held that it would be treated as a capital gain only. The argument was that of the tribunal was the land was purchased years back, and it was all these years it was being continued to be held as a capital asset only. At no point of time it was converted from capital asset to stock in trade. And with the passage of time and rapid evaluation, we know that now the land price has increased manifold. So it's not cup of tea for anybody to buy a large piece of land. And so to enable to sell the plot, it was the only option that land be broken into different parts, different plots, and then each plot be sold off. And this was like a one-off transaction. So it was held that this cannot be treated as a business income, and it was held to be the capital gain only. Now another is about section 50C. Now we know section 50C is also a very important section. This section speaks of the value as per the like stamp duty value, what we call it, and where the consideration is lesser than that. The issue was, for the purpose of section 50C, the land and building both are not to be considered separate assets, and their only joint valuation is to be adopted. if we read the section 50C, the section 50C1 says, where the consideration received or accruing as a result of the transfer by an SSC of a capital asset, being land or building or both, is less than the value adapted or assessed by the authority of a state government for the purpose of stamp valuation authority for the purpose of payment of stamp duty in respect of such transfer, the value so adapted or assessed shall for the purpose of section 48 be deemed to be the full value of the consideration received or accruing as a result of such transfer. So here the wording is used, the capital asset being land or building or both. So here the issue was whether for the purpose of section 50C, whether land or building or both land and building would be considered. So here it was said that land and building are not to be considered separate assets and that joint valuation is to be considered. Like transferable development rights, floor space index are also held to be the capital asset. Like section 50 is applicable only to land, building or both. Now in case of lease right, lease is neither a land nor building. So section 50C is not applicable to the lease rights. Same way, provision of section 50 also not applicable on transfer of tenancy rights. Now this is very important. Transfer of shares result in transfer of land and building. Sometimes people, what they do, instead of purchasing any capital asset, any land or building in their own name, they create a SPV and the purchase is done in the name of the SPV. So whenever they want to sell the asset, they would transfer the shares of that SPV. The question was, like, it's a private company. Here, an SPV was created in the form of private company, and private company was holding the land and building. So when the SSC wanted to sell the land and building, what they will do, they will just transfer the ownership, they will transfer the shares to the buyer. So then buyer would become the owner of that company and the company has got only the asset, which is the land or building. So he indirectly becomes the owner of that land or building. So the question came whether such transfer of shares by one person to another, in which the transfer is resulting into transfer of land or building. So whether in such case section 50C is covered or not. So it was held that transfer of shares of a company is a valid transaction. Like anybody as a shareholder, I have got my right to transfer the shares. Now the underlying company can have any underlying assets. It's not important. But as a shareholder, I have got right to transfer my shares. So it should be considered merely as a transfer of shares. And here, like lifting of corporate will co is not permitted. So this is a very important judgment in the form of the planning, where it was held that the transfer of shares of a company needs to be considered an independent transaction and it will be treated as a valid transaction. See, here the question was कि when is a question of slump sale. कि when business as a whole is being sold as a going concern for lump sum consideration. Now, this lump sum sale, slump sale may include land or building. So it was whether when such slump sale is being made and it include land and building, whether section 50C can be invoked or not. So here it was held that 50C applies only when there is a transfer of land or building. Now, sale of an undertaking is not a sale of uh, land or building. So here, in case of slum sale, the section 50C is not applicable. But now we have the concept of fair market value, so that needs to be taken care of. Now here this is also an important judgment about section 50C. So what had happened that SSC had sold its property and whatever was the entire sale consideration was deposited into the capital gain account scheme for the purchase of a new house property, and eventually had also purchased the new house property within the prescribed time limit. So he took the advantage of section 54F and entire capital gain was exempt. But then what happened that section 50C was invoked as the the assessing officer felt that stamp duty valuation is much more higher than what has been considered. And so he considered the higher valuation under section 50C. And after considering the revised valuation only, he to the extent of actual investment, he deducted the benefit of section 54F to that extent. So here it was held that as per section 54F, where the cost of new asset is not less than net consideration in respect of the original asset, then whole of such capital gain shall be chargeable. So section 54F speaks of the investment of the net consideration which has been received by the SSE. So whatever SSE has received should get invested to purchase a new asset. So net consideration for the purpose of section 54 is the full value of consideration received. So the higher valuation, deemed valuation in the section 50C is not a consideration which has been received or accrued to the SSE. So here it was held that provision of section 50C cannot be applied to section 54 for determining full value of consideration. So whatever SSE has received, he has invested. Now the assessing officer felt that the valuation under section 50C is much more higher. So the argument of the assessing officer was that he is required to invest the higher amount as per the STV. So it was held that for claiming the existence of section 54, whatever has been received only is to be considered and not the higher valuation under section 50C. Now here it was a case of short-term capital gain versus long-term. Now SSE had on short-term capital, he sold depreciable assets. So now any sale of depreciable assets is deemed to be short-term capital gain. But such assets were held by the SSE for more than 36 months. So technically, those assets were long-term capital asset. But as they were forming part of block of asset, it was considered as short-term capital gain. So section SSE claims deduction under section 54 EC. So deduction under 54 EC is available only for the long-term capital assets. So the question was whether short-term capital gain can be allowed under section 54 EC. It was held that deeming fiction under section 50 was only for the purpose of mode of computation of capital gain and not for other provisions. So as the capital gain which got arisen on sale of long-term capital asset, so cannot be, so the exemption under section 54 EC cannot be denied to him. So here it was a very simple case. HSE is holding assets which are a long term, but it are the depreciable asset. So it falls under short term capital gain. So he claims section 54 EC deduction. 54 EC is for long term capital asset. So this deduction was allowed to him as it was held that the basic nature of the asset was a long term capital asset. Now here, what had happened that SSE invested its entire capital gain in purchase of new house property. So under section 54 within the time limit, he made the entire payment to the builder. But what happened that the builder could not complete the construction within the prescribed time and possession was not handed over to him. The question was whether deduction under section 54 can be claimed. So it was told that booking a new residential house in under construction projects amounts to construction and not purchase for the purpose of claiming exemption. So section 54 is silent about commencement of construction and hence commencement of construction can precede the date of sale of the original asset. See, here is also an interesting case. What SSE did that he sold a property and he earned the capital gain, and he invested the capital gain for purchase of a residential house in the name of his wife. So he didn't invest it in his own name, but he invested in the wife's name. So question was whether deduction of section 54 can be claimed. So here it was held that section 54 merely says that SSE should have purchased or constructed a residential house. It doesn't require that new residential property must be purchased in the name of the SSE. So SSE had purchased new property in the name of wife and not in the name of any stranger who is not connected with him. And entire investment which was made in the name of the wife had also come out from the sale proceeds. So hence reduction under section 54(4)(f) was allowed. So normally we understand that whoever is the seller, whoever has earned capital gain, the new investment must happen in his name only. But here it was happened in the name of a wife, a spouse, and in spite of that, reduction under section 54(f) was allowed. Now here also is a case of section 54E, where SSE sold some plots of land and he executed sale deeds in 1982. But on account of litigation, final payment of sale concession was received in 1986. So after 1986, SSE made the investment and he claimed the deduction under section 54E. So question was, here the sale document, sale deed was executed in 1982. The last payment was received in 1986. So whether the period of 6 months would be considered from 1982 or 1986. So here it was held that what is important is execution of sale deed. Once you execute the sale deed, on that date transfer takes place. And from the date of transfer, the 6 months period, the counting starts. So as the SSC had not invested within 6 months from the date of transfer, the reduction is not available. Here also there is an interesting case where SSC sold a bungalow and he brought 3 different flats, but all the 3 flats were adjoining, connected to each other. One was in his own name, another in the name of his wife, and third one his own name, another in the name of SSC. जो भी है, तीनों उनको उनका फैमिली मेंबर्स के नाम पे उन्होंने परचेस कर लिया. So it was a joint name, so he claimed the reduction under section 54. So here what was held that 2 flats which were acquired under 2 distinct agreements and from different sellers, but the court observed that map of the 2 different flats was like a similar. There was a common kitchen, there was a common entry. So though it were 2 different flats, there was a single kitchen, it was looking like a single unit. And so the benefit of deduction was allowed. So I think that with this, I am through with my presentation. In this presentation, I have not gone into the basics of the capital gain. And I've just tried to touch upon the critical factors like provision of section 56(2)(10), section 45(4), section 45(3), section 9(b), and other important crucial judgments. So if anybody has anything to share, now the forum is open for all the members.
Sir, can you please explain the difference between 45(3) and 45(2)?
Pardon, 45?
3, subsection 3 and subsection 2, 45 subsection 2.
Section 45(2) and 45(3).
Yeah, subsection 2, 45 subsection 2.
Section, yeah. Now, is my screen visible? Yes. Section 45(2) and you say 45(3), right?
Yeah.
Section 45(2) is conversion of capital asset into stock in trade. Okay. And
Okay.
section, so when there is a capital asset which is being held by the firm, okay, by someone, and he decides that I am now converting my capital asset into stock in trade. Okay. So when such conversion takes place, naturally is now, it was earlier as a capital asset. Now it's not more my capital asset. So once capital asset is sold, it attracts capital gain. So when the conversion takes place, the capital gain is already due, but it is not payable. Capital gain would become payable when ultimately he will sell that stock in trade. Suppose, to give the example, suppose I have got 100 shares of, say, Reliance Industries, say 1000 shares of Reliance Industries. It is my capital asset. Now I decide that now let me start trading very actively and also deal in these futures options and all those blobs. And now it would be my main business. So I convert my 1000 shares of Reliance Industries into stock in trade. So what I have done, I have now, it was lying as an investment in my books of accounts. Now it would fall under the head stock in trade. So on that date, no liability would get arise of capital gain. Now suppose after 1000 shares, which I am now holding as stock in trade, I sell it of 100 shares. So when I sell 100 shares, the tax liability would arise. The tax liability would be in two parts. One would be capital gain, the other would be the business income. What portion would be the capital gain? Like the date of my original cost less fair market value on the date of conversion. So original cost, as it is a capital asset, I will have the advantage of index cost. So I need to calculate my index cost of acquisition. Then I need to calculate the fair market value on the date of conversion. The difference I have to pay capital gain. So I already paid the tax to the value of fair market value. So whatever I received over and above the fair market value as a stock in trade would become my business income. So sale value less fair market value on the date of conversion is my business income. And so when such transfer takes place, I will have to pay one portion as my business income, taxable in the profit under the head profit and gains of business or profession, and the other would be capital gain. So this is what about 45.2. Now 45.3 is transfer of capital assets by a firm, by a partner to the firm. I am an individual. I am holding certain asset. I decide that, say, suppose I have got an office in my personal name. I decide that now I will transfer this office to the firm. So when I transfer it, it falls under section 45.3 and it is taxable in my hand. Now it is a transaction between me and my firm. So it's not a transaction between me and any outsider. So when I transfer it to the firm, no bank transaction is taking place. It's just amount is being recorded in the books of account. So what will happen? The firm will record that yes, Mr. A has transferred this. Now this is lying in my balance sheet as a fixed assets, and my capital account will get credited to that amount. Now suppose I have got the building had got a value of, say, 10 crores. Office had got a value of 10 crores, and I have transferred to the firm. The firm records the value of 5 crores. So the section 45.3 says transfer of capital asset by a partner to the firm. The amount which is recorded in the books of account will be considered as the consideration value. So they are not here. They are not speaking of the fair market value of the asset or this stamp duty valuation of that particular asset, nothing. Whatever amount is recorded in the books of accounts by the firm will be considered as the consideration value. So as far as section 45.3 is concerned, this is the limitation. Now we cannot see section 45.3 in isolation, because whenever we transfer any asset for an inadequate consideration, section 56 subsection 2 clause 10 gets triggered. Section 56.2 section 10, I will read it again because very important section. Let me just open the act and read it out for a benefit. Section 56.2.10, it says any sum of money, where any person receives in any previous year from any person or persons on or after 1st April 2007. So this is applicable to any person. Okay, not limited to any individual. It can be anyone. So further it says subsection A, any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum. Second, now it talks of immovable property. Any immovable property without consideration, the stamp duty value of which exceeds 50,000 rupees, the stamp duty value of such property. So this is the section which is under income from other sources. Now B, for a consideration. Now here it was a case of without consideration. Here is a case of for a consideration, inadequate consideration. For a consideration, the stamp duty value of such property as exceeds such consideration if the amount of such excess is more than higher of the following amounts, namely amount of 50,000 rupees and the amount equal to 10% of the consideration. Provided that where the date agreement fixing the amount considered for import property and the date of registration are not the same, the stamp duty value on the date of agreement may be taken for the purpose of this clause. So this clause is very clear. If there is no, if anything is transferred having a value of 3,000 or more without consideration or with inadequate consideration, the same would be taxable in the hands of a recipient. So when I transfer my office building whose fair market value is 10 crores, but I transfer it for a value of 5 crores, then the balance of 10 minus 5, that would become taxable under section 56 to 10 under the head income from other sources, and the tax liability would arise in the hands of the firm. So this is the difference between 45.2 and 45.3.
Sir, in that case, what will be the rate of taxes in 45.3? Is it 20% or something other rates? Is it long-term capital? It is not long-term capital gain. So what is the rate for taxation? 20% limit long-term capital gain tax? No.
नहीं किसकी बात कर रहे हैं आप?
45.3 में, yeah, 45.3 में, yeah. You are telling it is charged on the income from other sources.
45.3 is नहीं section 45.3 में जो भी होगा, it is capital gain.
Capital gain, okay.
But section 56 to 10 is not under the head income from capital gain. It is income from other sources. Section 56 to 10 falls under, not under the head of income from capital gain.
Right, sir. My query is that in the case of 45.3, the tax liability will be only one tax, capital gain tax, and that will be 20%. I mean long-term capital gain. Is it like that? Yeah,
so far as the transaction is at the fair price.
Sure. Okay. So difference in 45.
If the taxability arises under section 56 to 10, then that chapter, that section falls under the head income from other sources.
Okay, yes. So, okay. So in 45.2, there are two taxes. One is the business taxes, one is the capital tax.
No, it's not a two taxes. Let me make it clear. See here, section 45.3 was a simple case. See, before 2017, it was simple case कि भाई जब भी कोई भी पार्टनर ने फर्म पे ट्रांसफर किया, फर्म ने जो भी वैल्यू लिखा है, that is the value. बराबर है. लेकिन 45.3 is an independent section. Section 56 to 10 is completely an independent section. 56 to 10 is applicable not only for section 45.3. It is applicable for any transaction where there is an inadequate consideration or where there is no consideration. 56 to 10 is a very generalized section. I have tried to link it to show that if you do this, then you are triggered under this section.
Okay.
My idea was to include section 56 to 10 along with section 45.3 was only to alert that yes, there is a flexibility under section 45(3) that you can record any amount as a consideration in the books of account. So section 45(3) does not warn you. He gives you enough freedom. But once you adopt that freedom, there is another section in the Income Tax Act somewhere written, okay, which gets triggered. So 56(2)(10) has got no direct relation to section 45(3). Are you getting it? Section 46(2)(10) is a very generalized section. It seeks, देखो मैं फिर से पढ़ता हूँ, इसलिए I am reading this section 56(2)(10). It is a very generalized sections under computation of income from other sources, where any person receives any previous year from any person or persons. So here it's not a transaction between a partner or to a firm. Any transaction, आपने किसी के साथ भी transaction किया, कोई भी concern लिया, which is at inadequate consideration, this section gets triggered.
Right.
Right. So my idea was only to show section 56(2)(10) here as that though we have got this flexibility, but this flexibility has got a very big limitation.
Okay. Now, sir, in last you explained the 45(2), there are two types of taxes. One is that business tax, another is the capital gain tax, isn't it?
Yes.
So again, just distinction is not getting clear. I mean, how much should be the business tax?
I will tell you. See, I will make it very simple. आपके पास कैपिटल एसेट हैं, ठीक है, आपने आज बेच लिया, सपोज आप सेल कर रहे हो, तो आपको कैपिटल गेन आप कैसे कैलकुलेट करोगे?
कॉस्ट ऑफ सेल वैल्यू माइनस द कॉस्ट ऑफ इंडेक्सिंग वैल्यू जो है वो डिफरेंस आएंगे,
तो वो आप कैलकुलेट कर लो। आपने सपोज वो कैलकुलेट किया और आपकी लायबिलिटी 1 लाख रुपया आई, ठीक है, क्लियर? 1 लाख रुपया आप पार्क कर दो समवेयर। अभी आपके माइंड में कई जगह पार्क करके रख दो कि 1 लाख रुपया की आपकी कैपिटल गेन की लायबिलिटी आ चुकी है। द एक्ट गिव्स यू द फ्रीडम कि वो 1 लाख आपको आज पे नहीं करना है। 1 लाख की लायबिलिटी आपकी फिक्स हो गई, पर 1 लाख आप कब पे करेंगे? आपने देखो ऐसा है कि आपने कैपिटल एसेट को स्टॉक इन ट्रेड कन्वर्ट किया, आपको तो पैसा तो कुछ मिला नहीं है ना अभी, तो
नहीं मिला,
बराबर, यू नॉट अर्न एनीथिंग। तो एक्ट इज गिविंग यू द फ्लेक्सिबिलिटी कि ठीक है आपने कन्वर्ट कर लिया, अच्छा है, लेकिन आपको अभी टैक्स पे करना नहीं है। दो टैक्स लायबिलिटी इज ऑलरेडी कैलकुलेटेड कि आपकी 1 लाख रुपए की लायबिलिटी आ गई, अपने पास रखो। जब आप सेल करोगे, सेल का पैसा आपके पास आएगा। सपोज आपने आपकी वो सपोज टू मेक इट सिंपल कि आपकी कोई एसेट है 1 लाख रुपए की है, ओरिजिनल कॉस्ट, इंडेक्स कॉस्ट समझ लेते हैं। आपने 2 लाख रुपए में जब ट्रांसफर किया तो उसकी वैल्यू 2 लाख रुपीस थी, फेयर मार्केट वैल्यू। तो फेयर मार्केट वैल्यू 2 लाख, लेक्स इंडेक्स कॉस्ट 1 लाख, 1 लाख रुपए आपका कैपिटल गेन हुआ, ठीक है। आपने उसको स्टॉक इन ट्रेड में रखा, फिर अल्टीमेटली आप उसको सेल करते हो 2,50,000 रुपीस में, ठीक है। तो बाकी का जो 50,000 रुपया हुआ, दैट वुड बी योर बिजनेस इनकम।
ओके, अच्छा।
और आपको उस दिन जब आप पे करते हो तब तो आपको पैसा मिल गया, तब आपको जो बाकी जो पुराना कैपिटल गेन था जो आपने कैलकुलेट कर रखा है, पे नहीं किया है, वो भी पे करना है, एंड वॉट एवर एक्सेस यू हैव अर्न वो भी आपको पे करना है।
At two different dates.
हाँ,
अच्छा, राइट, ओके।
कैपिटल गेन इज कैपिटल गेन, बिजनेस इनकम इज बिजनेस इनकम। आपको कैलकुलेट करके रख दो, पे बाद में करो।
अच्छा। But sir, in your presentation, one part is not coming. Suppose you are talking about the partners, right, sir? About the one topic has not been covered.
कौन सा?
Suppose I am talking about an individual, right, sir?
Yeah.
And an individual is having a small portion of any house property, which is coming as per the mutual understanding or the ancestral will or whatever may be. Now that person is selling to one of his co-owners, other brother or sister, something like that, and he has prepared a sale deed. So that is coming under sale. Since he has prepared a sale deed, it will come under sale. And there is a clause that if it is a capital, assuming it is a capital asset, so there is a clause that if that investment value is you can invest in some bonds, government bonds, REC bond or NHAI bond, it can be exempted. So that is coming probably some section 54E or some other section like that. So that is not being covered, sir. How does it come here? Because in the mention you are mentioning that in fit to a double E, this topic is probably not coming, or I might.
आपका नहीं, मुझे अभी आपका इश्यू क्लियर नहीं हुआ. आपका कहना क्या है कि
मेरा कहने का ना एक इंडिविजुअल है,
नहीं, आपके पास एक रेसिडेंशियल प्रॉपर्टी है. आपकी क्वेरी समझना चाहता हूं मैं.
राइट.
आपके पास एक रेसिडेंशियल प्रॉपर्टी है,
या
ठीक है.
सपोज एंसेंट प्रॉपर्टी है उनका एक क्वेश्चन है मेरे पास, राइट.
नहीं एंसेंशियल प्रॉपर्टी है, लेकिन वो प्रॉपर्टी अभी नाउ यू आर द ओनर.
No, I am not the owner. I am one of the co-owner. I am the co-owner with one of my family members, brothers, sisters, like that, right?
हाँ, तो it is a joint ownership of
joint ownership. Yes.
Right.
Now, as per the settlement in joint ownership, somebody I am selling it to my brother or sisters. Now some other person, and I have purposefully prepared a sale deed. I have not made any gift deed, right, sir?
Right.
I made a sale deed. So when I made a sale deed, it will attract capital gains. I mean, it is attracting capital gains.
Right.
And assuming it is a long-term value, say more than 3 years possession, so it will attract capital gains, long-term capital gains, right, sir? And it will attract tax for 20% rate. I mean, that rate, capital rate. Now, suppose this is applicable in the current year. Suppose I am to get exemption from tax, not to pay tax. What is the option left with me? I have to invest in the government bond. I mean, particularly that's a bond, REC bond or NHI bond, which is probably coming under section 54 EE, most likely, or some other section like that. So, and there the consideration is that either you have to invest the full value, or there also this clause is indirectly coming that whatever money I'm getting, that is not the consideration. At what value it is getting registered in in the court, that value will come into the picture. So obviously it is higher. So suppose I got 10 lakhs, it is registered at values of 17 lakhs at the court. So I have to pay tax on 17 minus the house value with the indexing of cost of acquisition. Difference I have to pay tax. Suppose I got the index value is 6 lakhs and I got the court value is 17 lakhs. I got the actual money 10 lakhs. So in true sense, I have to pay tax on 17 minus 6, 11 lakhs. I have to pay tax, although I got the value 10 lakhs, right, sir? Now to save the 11 lakhs bond, what I have to do, I have to make investment. Now I have two options: either pay tax on 20% on 11 lakhs, that is 2 lakhs 20,000, or I have to purchase a bond either 11 lakhs or more than value 11 lakhs. That means either I purchase bond REC or NHI bond for 11 lakhs. So that's my point, sir. That point is that point is not coming. I mean, that for individual case, what will be that treatment? Am I correct, or something is missing?
No, you are correct. You are correct.
So that part is coming. Which part is coming? 52AA. That.
I think 54 GB. You are talking about 54 GB, मेरे हिसाब से तो.
Anyway, this section I could not recollect, sir. I mean, issue is that it is only two options: REC bond or NHI bond. These two.
Pardon?
I mean, for tax exemption purpose, only two bonds are available: either REC bond or NHI bond.
Right. I think it was there. 54 EC.
EC.
Any other issue?
No, sir.
Tomorrow, I think there is no
chat,
session.
there is one question.
Tomorrow there is no session, right?
Hello.
Tomorrow there is no session tomorrow.
No, tomorrow I will announce that, sir. Okay,
Yeah,
there is
okay,
one in chat. There is one question. Land sold by brother for 27 lakhs, and he purchased house for 33 lakhs. Capital gain was 1.5 lakhs. He has other income of 3 lakhs. Total income is below 5 lakhs. This is for the assessment year 22-23. Whether he is liable to file return.
नहीं एक सेकंड, मुझे चार्ट में देखने दीजिए क्या है चार्ट में. मैं देख पाऊंगा कि नहीं?
हाँ देख पाओगे ना सर,
एक
जो
second,
मिनी ये जो शेयर स्क्रीन आप बंद कर दीजिए तो आप देख पाओगे।
एक second.
लास्ट क्वेश्चन है सर।
Yes, yes, एक मिनट।
Sir, you have read the last my question, but what is your reply, sir?
एक second, I'm just reading the section.
That land sold for 27 lakhs and purchased a house for 33 lakhs. Whether he is liable to file a return, he has no other income.
This was whether he's trying to file return none of the previous year are not taxable income for you. मेरे हिसाब से तो कैपिटल गेन 1.50 लाख का है ना?
या
हाँ, तो रिटर्न तो फाइल करना पड़ेगा ना?
रिटर्न तो फाइल करने पड़ेगा, तो टोटल इनकम 5 लाख के अंदर है ना?
आगे
Total income is below 5 lakhs, no? Then even then he has to file return, huh?
yes.
Yeah, okay. Thank you, sir.
I have one question. Hello,
Yeah.
sir.
Yeah.
Continue.
Sir, hello, can I speak?
Yes, sure.
Yeah, sir. If I have sold a house of around 3 crores, and if I buy a flat, 2 flats about it, if I sell it for 3.5 crores, and I buy a house, flat of 2 flats of 1.5, like total 1.5, having
Right.
85 or something. So on the remaining balance, that comes around 2 crores, right? So on the balance, if there is a senior citizen person who is doing this, like selling, super senior, like around 85%, he's a age.
Right.
So how much capital gain will he be having on that? Because he's a retired person, he's a super senior citizen, and he's selling a house and buying a flat. So what capital gain will he have to pay, and how much tax will he has to get into this?
This is very simple. He entire capital gain needs to be invested. If there is a shortfall, then capital gain tax उसको indexing करके जो भी cost है, जो भी difference है, उसका 20% पे करना है. उसमें senior citizen के लिए कोई अलग से advantage नहीं है.
अच्छा. He straight away has to. And what options will he have? Like some other person said that you can invest in government bonds and all that, which will save some tax. So do you have any options here also for?
नहीं आप बॉन्ड में इश्यू करेंगे, पर लेकिन अल्टीमेटली तो आपको वो बॉन्ड को भी सी इट्स नॉट लाइक परमानेंट आपने वहां पे पार्क करके रख दिया है.
अच्छा, टैक्स फ्री नहीं है वो बॉन्ड?
नहीं परमानेंट, लेकिन वो उसका जो अल्टीमेटली यू नीड टू यूटिलाइज दैट फॉर. देखिए इसमें ऐसा है, व्हाई द प्रोविजन ऑफ बॉन्ड कि अभी आप परचेज नहीं कर पा रहे हो, ठीक है? तो आपने
फ्लैट तो परचेज किया, सामने प्रॉपर्टी के सामने प्रॉपर्टी लिया, लेकिन जो बाकी जो होता है पैसा उसके.
हाँ
सर आई जस्ट suggesting sir the जो bond है ना sir, it has a limit of 50 lakhs. So suppose in the madam's question, I mean my submission is that suppose there is a 2 crore profit out of the, if it is invested in the bond, to the extent of 50 lakhs it will be exempted. This bond is valid for 5 years and they will give 5% interest per year, simple interest. That means at the end of 5 years, when the bond will be matured, that value 50 lakhs will be fully exempted, not to pay any tax. That much can be saved. And balance amount. And balance amount.
But if there is husband and wife, like there are 2 people, like husband and wife, so you can take in ownership of 50 lakhs for a husband and 50 lakhs bond in the name of wife.
But if the source is one, in that case it will be considered one only, because you are telling
only
that
one asset is sold, no?
Only one asset. They don't have any other source. That is the only source of income right now.
No, capital gain is only from one sale of property, no?
One sale of property,
yes,
no? That is the thing.
Yes, one sale,
So
one house.
maximum 50 lakhs can be exempted. I mean, that way.
In bonds.
With bonds.
Yeah.
And balance 150, you have to think some other arrangement. You may invest
Oh.
some other ways, senior citizen scheme like that.
Yes.
Best
yes,
of it is that in the senior citizen scheme, you can get higher, I mean, more return, something like that.
yes. But then he has to file return also.
Yes. yes.
Return, of course, yes. In that case, yes.
Return तो file करना पड़ेगा.
Acha. Okay. So there is no other way out like to save money other than bonds and SSC and all that.
No.
Okay.
नहीं.
Okay. Because
Sir, I have a question.
Okay.
Sir, I have a question. Sir.
Yeah.
So, sir, if total income does not exceed 5 lakh, but there is capital gain, what Mr. Kulkarni has said earlier.
नहीं कैपिटल गेन देखिए कैपिटल गेन तो आपको पे करना ही है ना कैपिटल गेन का सेट ऑफ कहाँ पे है
अच्छा कैपिटल गेन टैक्स पेमेंट करना ही है ना
हाँ यस
whatever if the total income 5 lakh then also capital gain tax has to be paid.
Yes.
Oh.
But it is below 5 lakhs still.
Yes, sir. If it is if the total income. Sir, my submission is that suppose we have different heads. We are first calculating income from salary, next income from house property, then income from other sources, then income from capital gains. For example, suppose in the income from capital gains, I find a gain of 1.1 lakh, yes. Right, sir? And in the other cases, some salary and other sources, I find a return in I mean extra payment of say 2 lakhs, or it is 1 lakh only. If it is net of sir, and if the total value is less than 5 lakhs, then no taxable amount is paid due as per the total rate, sir. In that case, sir, because tax has to be paid in totality, na, sir. In the form, the another group, although we mentioned a separate format, but in totality at the end, what we do, we have a different tax rate for capital gain, number one.
Right.
But for other things, we add all together, income from other sources, salary, etc., etc. Then we put the slab, and then we calculate the rate, sir. Then we find the total tax payable, right, sir? So in that way, when we make the total summation, that will show by net position, but how much to place plus or minus. If that is not coming any plus figure, sir, then how tax will be payable, sir? Then there will be no tax. Yes, I do agree.
No, that was my question.
That was I have to submit return. Okay, submit return will be nil tax, no tax. Return to submit. I agree, sir. But there will be no tax. No tax, nil tax or mine. If I get some refund I will claim. If I big bank can deduct about 10% interest or more, some refund will be coming. I will claim the refund. But return to be submitted. But probably tax may not be paid, sir. Only for capital gain.
What was his query?
His query was that, sir, suppose a person has three heads of income, one head of income capital gain, where it is amount payable is coming, and other cases it is coming no tax, right, sir? And in totality is coming less than 5 lakhs tax payable amount. So in that case, who's the amount be payable? That is the question, sir. Because tax rate is coming in totality, no, sir. Ultimately, capital gain shows a different rate of tax, sir, from others.
Yes.
That is the only difference.
Right.
So ultimately, we are finding the total tax payable, sir. Right. So for capital, there is an amount will be fixed at the 20% rate. What will be tax payable? Right. Like that for other income side, we have different rates of tax. That will never show what is payable.
Yes.
Now we add the total income, how much tax is payable.
Right.
No. What I told, if total income does not exceed 5 lakh, total income does not exceed.
Total income, then there is no tax.
There is no tax. Then there is no tax.
Acha. And capital gain, there is capital gain included therein. Yes. It means in this case, capital gain tax is not payable.
Thank you for all your clarifications.
Yeah.
I think it is the question raised by me.
Any other question?
Sir, can you share the PPT to all the participants?
No, we will upload on the website. WRC website. From here, there you can download the same. It is difficult to send to all the people.
Thank you, sir.
Okay.
Thank you, sir.
Yeah. Any other question? I would like to thank ICMAI-WIRC sir for his excellent presentation and explaining in detail the various provisions related to income from capital gain. I also would like to thank WRC staff for their continuous support and all of you for your support for the webinar on the income tax. For tomorrow, we don't have the webinar which was declared earlier due to Shivaratra. The same has been postponed to next Friday. Kindly make a note of that. Tomorrow there will not be any webinar.
Sir,
Okay.
please share the phone number, sir. Please share the phone number of Mr. Choksi.
That we will. I don't have ready. I will ask sir to share the number.
Yes. Can it be given in chat box, sir?
Hello.
Hello.
Can it be given in chat box, sir? Phone number.
Choksi sir.
Can be shared in chat box?
I think he left the. He is not there. I will share. I will ask him, the WRC team to share you the number. Okay.
Right,
He's
sir.
not there
Right.
for some reason. He's not there. I think he left the webinar. He's not there.
Okay. Okay, sir.
Okay. Thank you.
Okay, sir.
Thank you all. Good night. See you
Good
on
night.
next Friday. And
Okay, sir. Thank
our macro Excel webinar is there on Monday from 7 to 9:30. You can join that webinar also. Thank you. Thanks a lot.
Okay.
Good night.
Thank you, sir. Good night.